Following our recent analysis of Astronics Corporation, we shift our focus today to V2X Inc. They're a pretty significant player in the aerospace and defense services sector, currently trading near, $60 a share, with a market cap approaching $1.9 billion.
Right. And the core debate for V2X really centers on this crucial tension you often see in this highly consolidated sector. Can the company's, recent operational momentum and its strategic positioning successfully overcome what look like persistent financial vulnerabilities and, frankly, a challenging leverage profile?
Exactly. And I hold the bullish perspective here. I think V2X is fundamentally undervalued. I believe the market is mispricing the results of its strategic execution and what seems like a clear trajectory toward future higher margin growth.
And I will present the opposing argument that the company's significant debt burden and, structural risks, including really wafer-thin margins, impose a hard ceiling on any near-term upside, limiting its profitability, regardless of recent contract successes.
Okay, so VTX is demonstrating some impressive execution right now, especially considering the major organizational shifts over the last few years. Their Q2 2025 results didn't just beat revenue projections, they also exceeded adjusted EPS guidance. I think that confirms management's ability to integrate complex systems and, deliver actual financial results. We are seeing real momentum reflected in the figures.
Yes, the growth numbers look dramatic, but we have to understand why, right? That massive, almost 700% year-over-year trailing 12 months EPS spike, it's primarily the result of clearing the hurdle of significant integration costs post-merger. It's normalizing, sure, but from a very low base.
But that normalization is precisely the argument. Look at the sales growth consistently compounding annually at over 34% in the last 3 years and 25% over 5 years. This shows this isn't just stagnant government contracting. This is a growth machine really fueled by strategic transformation. V2X is moving away from basic services, positioning itself as a leader in, quote, data-enabled mission solutions by embedding AI and machine learning into its offerings. That's a key differentiator that should command future premium pricing.
But the current financial reality is, I think, defined by its debt. V2X carries a heavy leverage load. You can see that in the debt-to-equity ratio 1.07, and more tellingly, the enterprise value, which includes that debt component, is $2.84 billion. That's a staggering $1 billion more than its market cap. That differential is a giant flashing sign of leverage risk.
Well, that leverage is arguably the price of admission to secure the scale needed to compete globally. And they are winning. Their pipeline is robust, reported to be around $50 billion. And they have secured major complex awards. We are talking about critical logistics and modernization wins like the $4.3 billion U.S. Air Force T-6 Combs program and the $3.5 billion DTRA CT IV contract. These massive awards really solidify their global market share.
For a company operating with this level of debt, their margins are frankly concerningly thin. The gross margin is only 8.60%, and the profit margin is a meager 1.63%. These low margins mean V2X is essentially running a high-stakes, low-profit business model. Any unexpected operational slip or a competitive price war, or crucially, a legal cost, immediately strains their ability to service that large debt load.
I see it differently. That margin profile likely reflects the competitive pricing necessary to secure that scale and market leadership. The sheer volume from, the global defense spending tailwinds supports the long-term profitability of these contracts. We need to look at the forward earnings trajectory.
We also need to look at the warning signs coming from those closest to the company. We really can't overlook the significant insider selling. Insiders, including large shareholders like American Industrial Partners, have sold considerable amounts of stock in the months leading up to October 2025. Insider transactional activity is sitting at a negative 56.38%. When those who see the ledgers daily reduce their exposure so dramatically, that's a loud signal of concern about near-term upside, regardless of what the CEO might be saying positively.
Let's dive into the core tension here. Valuation versus that perceived leverage profile. The market frequently discounts defense contractors because of those high EV premiums. And that, I think, creates an opportunity for investors who trust the execution story.
But the current valuation multiples already seem to bake in aggressive expectations for that execution. The EV/EBITDA multiple stands at 9.43. Now, while that's not historically excessive for a defense contractor, it really requires flawless performance to justify. And crucially, when we look at intrinsic value models, we see these extreme discrepancies, which really highlights investor uncertainty regarding future cash flows.
Can we maybe clarify that dispersion for the listeners? What does that range look like?
Certainly. On one hand, you have models that use historical or comparable company valuations, like Guru Focus, suggesting V2X is actually modestly overvalued with a GF value around $48.36. This basically suggests that based on its current profile and debt, it probably shouldn't trade higher. But then on the other hand, you have these highly optimistic discounted cash flow, or DCF models. These project massive future cash flow, likely based on capturing that entire $50 billion pipeline you mentioned, and they peg the value as high as $119.09. The problem, of course, is that the high leverage structure ensures that if V2X misses the mark even slightly on that aggressive future cash flow assumption, equity holders will be disproportionately punished. The margin for error is just razor thin.
Management is actively working to mitigate the debt profile. They successfully completed a repricing and extension of the term loan, which shows they are managing the liability proactively. Furthermore, the market is pricing in the perceived risk, right? Which is exactly why the stock is trading below, say, the $76.72 intrinsic value estimated by valueinvesting.io. And the forward-looking metrics support the bullish argument. The forward PE is only 10.71, and projected EPS next year is $5.58. These numbers imply a strong expectation for future earnings normalization, and I think confirm the debt is serviceable.
I'm not convinced that just managing debt maturity offsets the fundamental strain of those really thin margins, especially when capital efficiency is so low. A forward PE at 10.71 might look good on the surface, but we have to ask what the company is actually doing with the capital it raises, much of which, as we've established, is borrowed. The return on assets is a weak 2.24%, and return on equity is only 6.86%. This suggests the high volume of assets and capital, much of it debt-funded through that high EV, is perhaps being deployed inefficiently. Or maybe it's simply not translating into strong shareholder returns yet.
Okay, but we must keep our focus on the growth pipeline. That's the engine that drives those future normalized earnings and hopefully improved ROE. Yes, the overall backlog saw a reduction from $13 billion down to $11 billion, but we have to contextualize that decline. It's happening against the backdrop of securing major new contracts, like the F-16 program support and that $140 million task order supporting Space Force. They seem to be diversifying away from reliance on any single area and winning in large, complex global markets.
That diversification is crucial, yes, but let's return to the risks inherent in those major wins. Litigation uncertainty creates a significant operational drag. That massive $4.3 billion T-6 comms contract, which involves critical base operations and logistics support for the Air Force, is actively being protested by a competitor. Furthermore, V2X is currently facing a related contract dispute under the Tucker Act.
Can you maybe elaborate on the implications of that second dispute, the Tucker Act one?
The Tucker Act specifically governs claims against the U.S. government for breach of contract. So this suggests that V2X might be facing not just competitive protest risk, but also potentially complex legal battles, possibly involving the client itself, the government. This kind of litigation introduces considerable uncertainty and cost, and that expense is magnified for a company operating on an operating margin of just 4.35%. This low profitability reinforces the idea that V2X is probably under intense competitive pricing pressure, increasing its vulnerability to those unpredictable U.S. government procurement cycles.
Okay, turning our attention then to corporate stability. While you've raised the significant insider selling as a flag, and it's noted, we need to look closer at the corporate response.
Well, beyond the debt profile and the low operational efficiency, the internal instability signals seem pretty hard to avoid. When insiders, who hold almost 28% of the company, sell off significantly, that suggests those with the deepest knowledge are reducing their exposure quite dramatically. That negative transaction activity feels like an anomaly that can't simply be dismissed as just routine profit-taking or diversification.
I would argue, though, that those sales often represent large institutional investors, maybe like major private equity firms who helped fund the initial merger, now restructuring their positions post-integration. It's not necessarily the core management team losing faith. We should probably focus on the current management's official signaling. The share repurchase authorization approved back in May is a direct active countermeasure to perceived market undervaluation. That, to me, signals confidence from the current executive team, which seems focused on the future, as shown by the recent successful acquisition of Quinetico U.S. intelligence business. That move expands their high-value national security capabilities and positions them, I think, firmly for future growth in digital integration services. So, to summarize my position, V2X presents what I see as a compelling growth story. It's fueled by strategic digital transformation, major contract wins, and strong short-term earnings beats that seem to validate the success of the recent merger. The optimistic valuation targets, in my view, reflect genuine future potential, based on an estimated forward EPS growth rate of almost 15% over the next 5 years.
The risk feels priced in, creating a significant opportunity here.
And I come at it, as you might expect, from a different angle. The core issue for me is that V2X operates with profound structural disadvantages. Those razor-thin margins, dangerous levels of high debt, and critical litigation exposure on key contracts. And all this is happening while those closest to the company are reducing their stakes. Investors really must weigh the aggressive growth assumptions, often based on the highest range of valuation models, against the very real downside risk inherent in managing a heavily leveraged balance sheet that's tied so closely to unpredictable government procurement cycles.